You're watching RT International. It's good to have you with us. Let's move on now. The biggest energy deal in history could be the catalyst that leads to the greenback losing its place as the world's reserve currency. That's the opinion of a range of economists, commenting on Russia and China's $400 billion natural gas agreement. And James Rickards, Senior Managing Director at Tangent Capital, joins us now live for more. Mr. Rickards, welcome to RT. Very nice to see you here. Obviously, the world is still relying mostly on the dollar while signing contracts and so on. And Russia and China are no exception here. Obviously, the price of the gas deal was announced in dollars as well. Clearly, it can't be replaced anytime soon. What do you think? I mean, if Russia and China, for instance, start paying each other in yuans and dollars, it's not going to work out anytime soon without the involvement of the dollar.
Well, it's important to distinguish between a reserve currency and a trade currency. Deals between Russia and China, or China and Brazil, or Russia and Central Asia, any of those bilateral trading relationships, it's fine to have the ruble or the yuan, let's say, as a trading currency, as long as the partners are willing to accept it and you have the banking mechanisms to take or receive payment. But a reserve currency is different. To be a reserve currency, you need a large pool of investable assets. The reserves are just a country's savings account. So if you have a trade surplus or you have direct foreign investment, you accumulate reserves and you have to invest them in something. For that, you need a bond market. And neither Russia nor China has a big enough bond market to serve as a reserve currency. There are very few Chinese bonds and not that many Russian government bonds. Russia actually has very little debt, for example. So they're not ready to be a reserve currency anytime soon. But there is something out there that could replace the dollar. It's not the Russian ruble or the Chinese yuan. It's the IMF's special drawing right, or the SDR. So I think the next time we have a liquidity crisis in the world, it's going to be bigger than the ability of central banks to deal with it. The IMF will have to basically bail out the world by printing SDRs. At that point, you may see the SDR, the special drawing right, emerge as a new global reserve currency.
Okay. What international factors pressure the dollar down?
Well, there are three big ones right now. I would say Russia, China, and Saudi Arabia. You know, since the 1970s, Saudi Arabia has been the leader in what's called the petrodollar. And it basically means that Saudi Arabia, and by extension OPEC, price oil in dollars. So the world market in oil is in dollars. There's no reason why that has to be true. Today, oil could be in euros, it could be in yen, Swiss francs, oil could be in gold. But Saudi Arabia has always supported the idea that oil would be in dollars. Now, even if you don't want dollars, everyone needs oil, and if you need dollars to pay for the oil, then you have to have dollars. And that's an important prop under the dollar. Russia, of course, is a major natural resource exporter, and they have priced their exports in dollars as well. But Russia is now engaged in financial war with the United States around the issues in Crimea and Ukraine. And over to China, China has $3 trillion in dollars, but they're buying gold as fast as they can. China worries that the U.S. is going to devalue the dollar through inflation, and so they want to have a hedge. If the dollar goes down, the gold will go up. So, you know, China getting gold, Saudi Arabia backing away from the dollar, the U.S. and Russia confronting each other. Three of the legs of the stool, Russia, China, and Saudi Arabia, are all being pulled out from under the dollar. So this is very bad news for the dollar.
Obviously, the U.S. Foreign debt is tremendous, and it keeps growing. Yeah, we don't see companies and states turning their back on the American economy and the dollar in particular. Why is that?
Well, of course, as you mentioned at the top, in the short run, there is nowhere else to go. That is true. But these things, you know, start out slowly, and then they can, you know, just like an avalanche or any other collapse, they can gain momentum, and confidence can be lost very quickly. Now, the problem is, you're exactly right. The United States has $17 trillion of debt. That's government debt. That's not counting all the unfunded liabilities for our Social Security and retirement, Medicare, Medicaid, student loans, Fannie Mae, Freddie Mac, all the guarantees. I mean, that amount is actually in the hundreds of trillions of dollars. There's no way, there's no combination of growth and taxes in the United States that can pay that debt. The only way you can pay it off is with inflation. Now, the Fed's trying to get inflation, but interestingly, because economic growth is so weak, because we're in a depression, the Fed's not actually getting much inflation. What they are getting are asset bubbles in stocks and housing, and then, of course, those bubbles will pop at some point. So, but the inflation's not here yet, but it is coming, and that's really the only way the U.S. can pay its debt. But that's one more thing that would drive other countries away from the dollar. Why would you hold dollars if the U.S. is just going to inflate away the value?
Mr. Rickards, thank you very much indeed for speaking to us. We appreciate it.